Hello and welcome to another episode of 10 Questions with Reunion. My name is Andy Moon and I'm the co-founder and CEO of Reunion, the leading marketplace for clean energy tax credits. We work closely with corporate finance teams to purchase high-quality tax credits from solar, wind, and other clean energy projects. Today's guest is Craig Smith, a partner at the law firm Wiley, Rein in Washington, D.C. Craig has significant experience in prevailing wage issues for federal contractors, and we are excited to have you on the show here today, Craig. Can you start by sharing a brief introduction on you and your practice?
Thanks so much, Andy. Delighted to be here. It feels just like just yesterday, I got thrown into the world of some of these federal prevailing wage requirements in this context with the American Recovery and Reinvestment Act of 2009, which many people may remember pumped billions of dollars into the economy through grants and other agreements. Stuff coupled with these types of prevailing wage requirements we're going to talk about today. And that's been a part of my practice in both the federal contracting space and other vehicles ever since.
Great. Well, this is definitely a hot topic for many clean energy developers today. I think for many of the current projects selling IRA tax credits in 2023, they tend to be exempt from prevailing wage and apprenticeship requirements, otherwise known as PWA, because construction on these projects started prior to January 29th, 2023. But PWA compliance is becoming a very, very big topic for 2024 projects, which requires diligence. So, Craig, for our listeners, can you do a very quick summary of PWA requirements for the purposes of IRA tax credits?
Sure. And I think the key term to keep in mind is Davis-Bacon Act, which is what all of this is based on. It's a nearly 100-old law that directly imposes requirements to pay certain wages and fringe benefits to the laborers and mechanics is a general term who work on federal construction projects. That requirement has expanded to all sorts of other projects through grants and cooperative agreements over the years. But the core point is the key points are the same. In a given area, you got to pay certain wages and fringes to certain classes of workers over the lifespan of the project.
That's great. And are there substantive differences between the PWA requirements under the IRA and the prevailing Davis-Bacon wage requirements?
It's a bit like when if my son were to come to me and say, Dad, you don't have to pay me an allowance, but every week you have to give me $5 for not doing anything. I've been hearing this, oh no, you just have to pay wages in accordance with the Davis-Bacon Act. You don't have to comply with the Davis-Bacon Act. I think for most folks, there's no real trade space between those two. For someone like me who's thinking about the administration or the enforcement and working with companies directly, there are some differences in the administration, the record keeping, and those types of obligations, which the implementation so far has recognized. But by and large, if you're just thinking about what do I need to make sure that the people are getting paid, I don't see too much difference in that.
That's very helpful. Well, I guess on that note, the first substantive updates in almost 40 years to Davis-Bacon and related acts became effective just this past week. Were there any major changes in that? And how will this impact buyers of IRA tax credits?
I think that there are two that for this market should draw attention, both of which will take some time to really be, I think, more salient, and they do require attention and diligence. One is that DOL has reverted to a prior method of calculating the prevailing wage. They have certain methodologies where they look at are most people in an area making a single wage rate. For the last 40 years, if the answer was no, they've just taken a weighted average. What they've gone to is reinserted in the middle of that process are there 30% of the people. So kind of like a big plurality. Where I think you're going to see that make a difference is in geographic areas where maybe there's a fair amount of union labor, but not a majority. And it could be at some point next year, the year after, 5 years from now, all of a sudden the wage rate for iron workers or electricians pops up to reflect that change. So not a today, not a tomorrow change, but something you need to account for. The other is that the site of the work that's covered, who's going to be in the area where you have to pay the wages, it's steadily expanding. For your viewers, it's probably not a big surprise that as modular construction continues to grow, the Department of Labor is focused on getting the same kinds of work covered, and so these secondary sites of work. It's going to take a little while to see how these changes play out in practice. But I think that while if you're just, to use an easy expression, if you're delivering the windows for the building, a lot of times that's just supply or the steel that you're using. I think when you start assembling things off-site, it's going to get more complicated and require more attention.
Can you maybe go into a little bit of detail from a practical sense? If you're a developer and you're trying to make sure you get the correct labor calculation, how should you think about, let's take that example, geography of work, where the component was assembled. What's the process for ensuring that you're complying with DOL requirements?
Geography is the easiest place to start because the way the Davis-Bacon Act worked is wages are set first by geographic area. Counties are the most common dividing line. You'll see such and such a county is in wage determination 1, 2, 3, 4, 5, along with 3 or 4 other counties, for example. There are some projects that, of course, cover multiple counties or other geographic areas. Let's save that for the 201 interview. For now, you can just think about one county. Then you have to ask yourself what kind of work is being done, because there are 4 types of Davis-Bacon wage determination. They're fairly self-explanatory: building, highway, residential, and heavy. Of course, in the edges, it can get tricky, but what DOL has done is provided some guidance that solar, wind projects use heavy. So when you click through in the website where these are published, it's www.sam.gov. You want to make sure you'd start with heavy. Not 100% of the time, but that's the place to start. Then you look at, well, who's going to do the work? And DOL has recognized we don't have a labor category for installer of solar panels or fabricators of wind turbines. So really distilling, do we have electricians? Do we have iron workers? What are the trades involved in the work is the next step. And from there, you go down, you read, and it'll have a wage rate and a fringe benefit rate. And the one factor to bear in mind is fringes can be paid just as part of cash wage. It's so it doesn't mean I have to run out and sign everyone up for a 401k and a health plan, but just at some point the dollars you're spending per worker per hour have to match up with what's in that wage determination.
That's super helpful. I guess one other question that's come up is the timing of the work. You've mentioned that sometimes the prevailing wage for iron workers might increase. How does the developer ensure that they are using the correct timing of the wage determination?
The lodestar is when the construction, the facility begins, or the other work where the installation work's being done. There are some, again, at the edges, but for getting familiar with it, think about when are we going to start swinging hammers or digging shovels, so to speak. What's important to realize is you'll be able to go online and see what's the wage determination today. But I think the challenge there is you'll already have the contracts. You might have already bought long lead items. You probably have pricing. I mean, the project is going to be fairly well advanced. So understanding what is the mechanism for looking to make sure we have the right wage determination and if there are any changes. That's not something that a federal construction contractor who, say, gets a contract from the General Services Administration to build a building. There's a defined process for doing that. It's a little painful, but everyone knows what it is. Here, it's going to be looking into, well, what is the plan for if that situation arises?
Got it. And I guess digging into the mechanics there, how are developers currently documenting this PWA requirement?
There's a wide range of ways to do it. And let me give you some context from Davis-Bacon, which of course has been around for a long time. Some companies do it in a very kind of manual, almost like Excel driven. They've got an admin who sits there and keys it all in. Some have much more automated systems. Some maybe rely more on payroll and kind of plan to extract the data, although I'd say make sure you can do that before you try it. And then some companies, and this is important to realize, as you get further and further down the subcontract chain, some companies are just flatly unaware of it. I give the ARA the example. A partner of mine and I, we spent quite an interesting project some years ago talking with, I think, 3rd or 4th tier subcontractors who they were paid on a piece rate and had never heard of the Davis-Bacon Act. Well, I mean, I understand it because it's such a small portion of their work, but it's a reality here for a taxpayer who's even one further step removed than a typical prime or GC.
Yeah. And I mean, because the taxpayer is the one that's on the hook for ultimate deviations from the PWA, how are buyers mitigating their risk here? Are there situations where they can just rely on the representations from the EPC or construction company, or sort of how deep does the buyer need to go on the diligence side?
There's a, people get into this business because they have some appetite for kind of taking risks and investing. And I think buyers need to think carefully about what is their appetite for risk and the information available to them. What would a kind of compliance lawyer tell you? I'd want to have detailed documentation of every hour worked by every person on this project. I want contact information. I want to know what's going on week by week, because that's the gold-plated way to make sure that you're handling compliance. But as your investors and buyers and other folks probably know, you pay for that. And so the question is, what's our risk tolerance here? A certification may be effective if it's a company is familiar with Davis-Bacon, or it's a tax credit seller who's using a contractor is sophisticated, and maybe there's a good enforcement mechanism for if I learn, or if I'm going to be indemnified if it comes along down the line. So I think it's a combination of what is the right blend of information and enforcement that's going to work with me where the investment still makes sense.
Yeah, absolutely. And we've heard that contemporaneous documentation is one of the key elements in really making sure that documentation is sufficient. What are some other points that you would advise developers to really be keeping an eye on as they are documenting PWA?
Well, let me give you a variation of that contemporaneous documentation item, which is you've got to make sure everyone knows that this requirement applies. And if you think about many of the projects, how would someone who's just there to show up and install the solar panels know? I'm not seeing a whole bunch of federal acquisition regulation clauses like I would for a federal construction contract. What's the tip off? So the first contemporaneous documentation is making sure everybody knows what we're supposed to be doing here for wages. And then, yes, I think understanding how are these companies tracking payroll? What are they accumulating? Maybe you're not getting it on a real-time basis, but understanding that process so that if you have to go back and reconstruct it, it's not, well, we had some electricians who came in and paid their guys in cash and they've all disappeared to the wind. That's probably not something, when you think about, do I want to show up $5 an hour short for a multi-million-dollar tax credit at some point where I can't find the workers? That's probably something where I'd want to be looking at. I need more information than that.
Got it. And I guess one follow up, in terms of, I understand what you say when some developers are tracking this manually with spreadsheets, others are using their certified payroll. What's the role of consultants, and how does that typically work when a consultant is involved in sort of ensuring that PWA documentation is happening correctly?
Let me talk about that certified payroll term for just a second, because that may be new to a lot of folks.
Sure.
And there is under the Davis-Bacon Act itself, and some of they're called related acts that impose the requirements. Every week, a contractor and subcontractor who's covered has to prepare what's called a certified payroll, which lists out all the Davis-Bacon covered workers, their hours by day, how much they got paid, and someone certifies under the Federal False Statements Act that Davis-Bacon wages and fringes have been paid. You can think of that again as a bit of a gold standard, and that's not required under the IRA. That's pretty clear. However, the government will tell you that's a really good idea. So when I'm talking about what kind of information are we getting, you might see some companies give you certified payrolls, or maybe they use the certified payroll form. Viewers can find it just by Googling WH Whiskey Hotel 347, and they'll find it online. You can just visually see what it is. So it's a PDF form. You can also do kind of an electronic form. So while looking at the PDF, some companies are sending PDF after PDF. Other companies have moved ahead in how they handle it. So that background, I think, tells you, well, what do consultants do? They can help with trying to just wrangle all the information, because it may be, you're learning this all on the fly. They can help with saying, if it's a more construction oriented consultant, they might help you with How realistic are these labor categories that someone's chosen? Is iron worker, journeyman really what these people are? You could also have consultants who just help with automating the process of, you can think of almost like unstructured data. Your seller, the agreement is they're just going to take whatever they get from the general contractor, who's just going to roll up everything from the subs. No one's sitting there to make it look nice and pretty in one single report. You could, for enough of these projects, even have a consultant who maybe builds like a light website that kind of handles this. So there's a range of services out there that you could imagine that someone could build. And they, again, may know the Davis-Bacon Act very well, depending on what you're engaging them to do, or they may just be kind of technically proficient and can help you with automating workflow, just like they might some other things you do around the office.
That's a great explanation. And going back to Davis-Bacon and certified payroll, under Davis-Bacon projects, is it historically common for a main contractor to require subcontractors to submit certified payroll as part of the requirements?
It's a contractual requirement, so there's no getting around it. And think of a reverse cascade. The payrolls are supposed to make their way to the contracting or the grant making agency. So if you've got a contractor who is familiar with the federal space, that may be actually the simplest way for some companies because they already have a workflow for it. Others might go, we do those for federal projects. We're not doing them for your project. So we've got to come up with something else. But at least it gives you a frame of reference for what's the type of information we're going to want to have if there are both for monitoring in process, or for if there are questions 5 years later when the IRS comes calling to reconstruct what happened.
It's very helpful. Now, one item that's been talked about a lot in the context of IRA credits is the cure period. In other words, if a taxpayer or a developer is determined that workers were not paid prevailing wage, the tax credit is not automatically just repealed. There is a chance for the prevailing wage failure to be cured by paying the worker the difference in wages plus an underpayment rate, plus an additional $5,000 for each worker that was underpaid. Can you comment a bit on the cure period and sort of practically how would this work?
My comments are generally about how poorly thought out this is, but let me try to help folks think about, well, what do we do about that? And let me contrast it with the Department of Labor. So a regular Davis-Bacon project where people do get underpaid, even with the most compliance-oriented companies. This is hard. And so I want people to understand, like, this is going to be hard squared because you don't have some of the infrastructure from federal projects. So here, you typically in Davis-Bacon, you would have the Department of Labor determine, let's say, these workers were paid wages from an outdated version of a wage determination. You owe them all $2 an hour more. Here are the hours, and you remit the funds. And then typically, if you can't find the workers, and this is also true in the services space, you can pay the money over to DOL, and they try to find them and pay the money out. Here, and so there are two principal differences here for any type of cure. One is both the statute and the proposed and implementing regulation, the proposed regulations and the guidance are written as though the taxpayer is paying. Well, you may be responsible. I think everyone understands that. But I'm a tax credit investor. I don't have an employer-employee or even an independent contractor relationship. And there hasn't been great thought taken to that kind of mechanics. Some companies, they have internal controls, especially if they're publicly traded. It's a nightmare to try to do these things. Can't you just pay the workers? Well, no, they're not our employees. So I think I'm hoping that as rules start to get finalized by the Internal Revenue Service around this, there are proposed rules that are, as we're recording this, the comment period is open. That's something that needs to get fixed. But if not, taxpayers may need to kind of think about ways that we're going to be paying people potentially. How do we do that? The other is that I mentioned the mechanism for paying workers who you can't find. It's one thing in the middle of the project to realize there's a mistake and you're able to arrange for the electrical subcontractor to make a back payment. It all gets worked out. And in that case, although the taxpayer didn't make it, you could imagine people are going to understand that people got paid. But where the project is over, maybe there's a challenge to the tax credit years later, trying to find the workers. So far, all the Internal Revenue Service has said is in their proposed rulemaking is, well, look to state law for how you would pay these people. I find that deeply unsatisfying, and I hope that gets resolved by the time anyone has these issues. The good news is, as you mentioned, we're just now starting to see projects come online that are subject to these requirements and so it's going to be some time before I think we're trying to do after the fact fixes. Right now, with projects, making sure there's mechanisms for validating in process, it should be, able to handle those kinds of shortfalls. Should be able to get handled in the ordinary course of, back pay. Whether it's on a paycheck or a special payment. It's going to be a lot easier to catch these in the moment than after the fact.
Yeah, those are great points. Just to clarify, so if there was an underpayment on prevailing wage, I would assume that the first course of action would be, because the project developer has a fulsome indemnity, they will have to make the buyer whole. So I would assume that there would be a strong incentive for the developer to actually play a role in helping cure the underpayment of wages. But in the event that that is not able to happen, you had mentioned that the penalty can be paid to the DOL, which will make their best effort to locate the folks that were underpaid. Can you just talk through those mechanics a bit? I mean, is that a correct summary of sort of how this might happen in practicality?
That's how it would work in the ordinary course of a Davis-Bacon project. Here, we don't have that mechanism. And so I think here, if let's say I'm a developer or I'm an investor either, and I've got an uncooperative general contractor who's just saying, no, that's not my problem. And we don't have legal recourse, or it's too expensive, whatever the case may be. I think there, understanding where the project is and engaging a local counsel or a counsel who's familiar with kind of construction projects in that jurisdiction to understand this certainly won't be the first time that workers are kind of discovered to be owed money after the fact. So for now, the time being, the best advice we have is look to state law, just like the proposed rules from the IRS say to do. It's not a satisfying solution, but it's the best one that we have. The other piece to think about is, I think you've made a great point there, Andy, that although you're on opposite sides of the bargain, the developer or the seller of the credit and then the buyer, the interests are aligned because you both want to make sure that everyone's getting paid the same rate. As you move further down, you're further from kind of that core transaction under the IRA. People have other things to do in life. And while everyone wants to comply, at some point you just have to realize, what do we need to do to make sure we're all rowing in the same direction?
That's great. And Craig, you've been in this space for a long time. Is there anything that I could have asked or anything that we missed in this discussion today about prevailing wage?
I think the one thing I just want to reemphasize it because I've said it all right, is companies who spend a lot of money to get this right still run into difficulties. So I would really want to understand this from a very practical perspective before I started trying to quantify the risk, modeling it out, talking about I mentioned earlier, what's the right balance of information and enforcement. Some companies may look at this and say, I'd rather just have, a really nice indemnity or liquidated damages, something along those lines. Others may want to be more proactive based on their comfort and understanding. But if you just look at this as make sure people get paid the right wages and fringes, that should take care of itself. I have a career in this field for a reason. It's because it's really hard to do, even for those who work really hard to get it right.
That's very good feedback. And one last item that I'd like to bring up here. So tax credit insurance is certainly one area that buyers are using and leading on to mitigate risk on these projects. And tax credit insurance does cover qualification of the credit, which would include verification of prevailing wage and apprenticeship requirements. How have you seen this play out in Davis-Bacon projects where it's determined that prevailing wage was not paid? Has there been insurance available, and sort of how has that mechanically worked?
It's a little too early to see how it's playing out. I think because, as you mentioned, we're less than a year in on that. So I think maybe this is a question for this time next year to see not just how is it getting bought and sold, but are we running into these kinds of issues already? Because if nothing else, we'll have had our first tax filing season. And some of the you can pay someone up the prevailing wages right away if there's a shortfall. But so far, the plan is the $5,000 or greater penalty that wouldn't be due until tax day. And so there is a little bit of I think, a lag here before we start seeing what's the reality on the ground.
Well, thanks so much, Craig, for coming on the show today. It's great to learn from your experience of working on federal contracting issues, and certainly hope to work with you in the future on perhaps one of these projects.
Thanks so much, Andy. This was a blast. Really appreciate it.
Hi, Craig. Happy New Year and great to see you again.
So great to be back. Hey, Andy, how are you?
Very good. Very good. So the IRS issued this update to Section 48 ITC guidance back in November, and that did include some updates to the prevailing wage and apprenticeship guidance. So would love for you to just give a quick high level to our audience on what should they know about the updates on the PWA front.
For this group, I think the important thing is to think about, when we talked last, I said there's a lot of pieces or processes that still had to be defined. I don't want to get into the level of granularity of the updated guidance, but in general, some of those pieces are coming together in terms of reporting or record keeping. There are others, some of which have, I think, a big impact on risk assessments and pricing that may take some time. For example, we just don't know how in practice the IRS is going to handle the returns that will include these tax credits, and then also if there are ever disputes. But at least some of the how do we even get there, it felt like it's starting to come together.
Is there anything in particular that buyers and sellers should be aware of? For example, there was a specific requirement for an annual PWA compliance report to the IRS. What does that look like?
It's kind of an aggregated report of wages, for example. And what the November update did, it wasn't a terrible surprise, is say, hey, for the construction phase reporting that was in the August proposed rule, it's kind of a parallel for during the recapture period where you have to pay prevailing wages for repair or alteration of a qualifying facility.
Got it. And I guess on the topic of the 5-year recapture period, the November guidance did not have any references to use of apprentices during this period. Uh, any insights on whether apprentices are a requirement for the alteration and repair period on 48 ITCs?
One of the things that I do, as a lawyer, is go back to start with the text. And I'd say that's an area that isn't as crisply written in the IRA as some of the others when it comes to prevailing wage and apprentices. And I think what companies now that are looking to be in this market should be thinking about is a final in the Federal Register answer from the IRS, and then any challenges to that one way or the other will take time to play out. So I think the most important thing to say is, if we want to be risk averse, maybe think about we should probably plan for apprentices. If that's not the direction you're going, having a plan for if that is the ultimate outcome, allocating risks and responsibilities will be an important discussion point.
Awesome. Thanks, Craig. Is there anything else that I should have asked today?
I think at this point, just paying attention to the interplay between the Department of Labor, which you might remember had published some new Davis-Bacon or substantially updated Davis-Bacon rules, making sure people continue to pay attention to in-the-field developments. Since we last talked, there hasn't been much. I think some of it may stem from all the other competing priorities at the Department of Labor. But I think just paying attention to that and not over focusing on the IRS, but keeping an eye on, the workaday, we'll call it, Davis-Bacon rules that are the subject of all of this. This is a great time just to remind people that there are changes afoot, even if they might feel like they're not quite as forefront as record keeping or reporting.
Great. Well, thank you so much, Craig. Great to see you again.
It's been great. Thanks for having me back.